The risk management is obviously the most important part of trading. It is worth to understand that um, this is not a holy grail to trading. There is no strategy which is a holy grail to trading. You are taking a trades which have a skewed risk reward for your favor, but outcome of every trade is basically random. And because of that, you must understand that trading is a long-term game of probability. Building a risk management profile and sticking to it is a key. You cannot risk 10% of your account on one trade and then on the next trade risk 1% of your account. You need to have a risk management system which you will stick to for, in any kind of circumstances, because once you start changing things midway, you will only be causing more and more troubles. The risk profiles then differ based on the trading approach you will choose. Before we are going to take a look at a risk management, I want to talk about brokerages, because this is something not many people talk about, especially in crypto, because everyone is too busy promoting their referral links for brokerages as they get money from that. But brokerages can go down, especially in crypto. There is a quite a high likelihood of any exchange just disappearing any day, and this is also case for futures, which happened plenty of time in past. Because of that, there is no reason to exposing yourself to brokerage risk, thanks to the leverage. I covered leverage, but obviously leverage allows you to open a bigger positions than your actual account is. So if you have $1,000 in your account, you can, with $1,000 in your account and obviously the 100x leverage, you can open a position which is worth $100,000. Should you do something like that? Of course not, but this is obviously a problem with leverage, which people often blame for their personal losses because they basically just gambling. But if I want to be trading with $100,000, I don't need to have those $100,000 on a brokerage account. Usually what I keep is around 20%. Okay, nowadays I have a little bit more. I have around 30% in the derivatives account, but there is absolutely no reason for that. Obviously, your broker, it looks like you are risking 5-10% for on every trade, but in reality you are just keeping your money safe somewhere. If you are trading futures, this obviously can be your bank account. If you are trading crypto, you can put the money in work. You can hold a spot, or you can do any delta neutral strategies, or you can just kind of be farming any passive yield in stable coins. For example, even something like FTX will pay you around 5-10% a month, and if you spread this money across different venues, you will be earning some passive income on your money, rather than just having everything in one futures account and trading with that. The risk reward ratio measures how much you risk compared to your reward. This is the most kind of a simple tools to risk management, but it's never fails. It's a good thing to use. Obviously, the more experienced traders do more experienced things, but I still stick to this classic model of risk reward ratio because it's just simple and it works. There is no reason to overcomplicate things. By taking trades with favorable risk reward ratios, it will lead to longevity in trading and your account just growing. So if you take a look at this example here, you can see that you are risking a 5% move to the downside in the asset, and your reward is if this market will move 10% higher. So obviously, if you will risk $1,000 by entering here and your stop is placed here, which would lead to this loss of $1,000, as market will, hit this 2 to 1, or this is 196 risk to reward ratio, you will be walking away with $2,000 by originally risking $1,000. So this is the classic approach to risk to reward ratio, which just simply works. Let's take a look at some different equity curves. This is assuming you are starting with $10,000 and you have 1-to-1 risk to reward ratio and you are winning a 50% of times. This is basically your coin flip in terms of kind of a distribution of winners and losers. And as you can see, the equity curves are also kind of randomly distributed. There's one which had a nice streak of winners and ended up quite positive, but the others just kind of fluctuate around the starting point, and basically half of them is in the drawdown and half of them is in slight profit. This is, if you remember the kind of the standard distribution in the auction market theory, this is no different. You have your kind of a value area here where 70% of these equity curves happen, and then some of these are outside of this standard distribution basically. 10,000 euros to begin with, but you are winning in 70% of your trades, and you can see how even having a 1-to-1 risk to reward ratio, so for $1,000 you risk, you will lose $1,000 or win $1,000. You can see that over 100 trades this is nicely growing up, but this is still not something where I would say you want to be. But this is just an example of this thing just growing slowly after the 100 trades. This is starting to get closer where you actually want to be. $10,000 to begin with, still 50% win-loss ratio, so you are basically flipping a coin if your trader is a winner or loser, but your winners are twice as big as your losers. And as you can see, there is one occasion where you would start in a kind of a string of losses, but at the end of this 100 trades you will end up profitable. And some of these curves are really profitable, some of these struggled a little bit, but every single one of them ended up in a profit, and your kind of a mean is around 60% profit over the 100 trades. So this is a 500 trades, and this is this kind of longevity I was talking about. You can see that over 500 trades, all these kind of drawdowns are really not even visible, and you are just ending up in profit on all of these equity curves. Here comes one thing you need to think about though. How long it will take you to execute these 500 trades. If you are day trading and you take 10 trades a week, it's going to be quite quick. It will take you a couple of months. But if you are swing trading and you will take 10 trades in a whole month, this can take a couple of years to achieve. So having kind of a understanding of how long these things can take is important. Also, all these equity curves are risking only 1% of your account on each trade. So in all trades you are starting with 100 euro risk, and once your account is growing, obviously your risk is also increasing. This one is the same, and here is one of those things that if on social media, obviously everyone is winning all the time, everyone is posting trades that are only winners, and no one ever loses a trade. In this example, you can see though that you are losing more than you are winning. You are only right 40% of times, but you're winning 3 times more than you are losing. And once again, you can see that although there is some sort of struggle at the beginning, you will end up in profit after 100 trades. All these equity curves are well in the money. So this is the example that you don't absolutely need to be right all the time. And if we take a look at, this is a blog post I published about risk management a while ago. Here is a table of probability of consecutive losing trades based on a winning probability. So we can take a look that if you have a 40% strike rate, there is a 50% chance you will get 8 losing trades in a row, which is quite big. And this is also something you need to kind of consider when it comes to your personal trading, because I know people who are only kind of focusing on a smaller risk to reward trades, around 2 to 1, but they have a high win rate, around 70-80%. So they are not winning big, but they are winning a lot. But I also know people who only take trades that offer 3 to 1, 4 to 1, 5 to 1 risk to reward ratios, but their win rate is really small, around 30%. If you are taking a 5 to 1 risk to reward trades, you will be well profitable with the 50% strike rate. I think on a blog post there is a table about it somewhere. You can see, if it's not even here, but if you can see that if you take trades with only 3 to 5 risk to reward ratio, you only need to be right 22% of times. But on the other hand, with 20% of win rate, there is a 97% probability of having a 10 losing trades in a row. And you need to think about if you are able to kind of stomach this, because obviously it's one thing to see these things in these sort of simulations, but the other thing is actually, especially if you are swing trading or taking only a handful of trades every week, and you need to ask yourself, am I able to sit in drawdown for 2 months, for example? Is this something that I will be completely fine with? And although most people think they will be fine with that, in reality it will start to getting to them very quickly once this drawdown happens. So this is something you need to consider as well. Here is a 60% win rate with a 2 to 2.5 risk to reward ratio. This is a solid trading performance, but this is something, once again, a lot of people think the trading is about that you will be winning with every trade. This is a equity curve of only 15 trades, and although most it's overall profitable, the outcome is more of a random one. If you only take a look at small sample size of trades, you won't be seeing any awesome results. Like I said, you need to be looking at things like this. You need to be, this is 200 trades, and you can see how well this thing is growing. So once again, focusing on staying in a trading for a long run, not taking 15 trades. This is, you will see, you are in drawdown, it's not working, so you will just kind of give up. Let me actually talk to you about where I am with these things, or where I think it's kind of a most comfortable way, as I currently trade this kind of a swing strategy. That's like more of a intra-week trading system. I take around 3 trades every week. Sometimes it's up to 5, sometimes it's less, but I only take trades with 2 to 1 and above risk to reward ratio. If I think taking trades with lower than that is fine, but since I trade more markets, I believe that you can find the opportunities which will give you at least 2 to 1 risk to reward ratio, and the win rate is also kind of, in real trading, the risk to reward ratio is not same for every trade. If you are not using any sort of systematic system, it will change, and your win rate will also kind of change throughout the whole trading. But I am sitting above this 60% range, and around 60 to 70% is kind of ideal. So this is basically my kind of a ideal equity curve, which I also try to achieve. I rarely take trades that are 5 to 1, for example. That's too overshooting for me in a lot of cases, but I can find the trades between 2 and 3.5, let's say, and my win rate will, fluctuate between 50 to 70%. So, I know in the long run it's a profitable system basically, but the outcome of every trade and kind of short-term price fluctuations needed to be, considered with that. So, risk management adjusted to trading style. The risk percentage should be adjusted to trade frequency. Day traders should risk less as they are more likely to experience string of losses, and you should be risking more on a swing trades. If you, let's say you are day trading, you take 3 trades every day, and you will risk 4% each trade. You will hit 5 consecutive losses and you are down 20% on your whole account. That's not great. There is no reason to risk that much if you are day trading. But if you are taking a long-term swing trades and you only execute 1 trade a week or 2 trades a week, risking 0.5% doesn't really make sense. It will take you ages to grow your account. Once you are comfortable with things that you are doing, you can risk around 2 to 4%, let's say, and still kind of have positive expectancy in the long run. So correlated markets, this is something that a lot of people are not considering. There are different types of correlations in the markets. These, you can see these are correlation coefficients, which means that if you have if this number is 100 or very close to 100, which if it's 100 or close to 100, the closer to 100 the more correlated these assets are. If it's 0, there is no correlation whatsoever, and if it's minus 100, the correlation is negative. So you can see that how correlated is crypto, for example. Obviously some pairs just tend to run on their own sometimes, but more often than not the correlation is pretty high. In Forex, the pairs are also highly correlated. Euro USD and GBP USD has 88 correlation, and USD Swiss against GBP USD has negative 97 correlation. In the kind of futures and index futures also the correlations are quite high. ES and NQ has a 96 correlations, and overall these markets are correlated. Why this is important? It's important because let's say that you take a long in Euro USD, GBP USD, and you will short USD Swiss. You will take these 3 trades at the same time because you see the setup happening in them. This is all great, but it only takes one kind of piece of news that will cause a strong dollar, and which will more likely than not lead to losing trades in Euro USD, GBP USD, and all these 3 pairs will end up in losses. So, and you will keep wondering what happened, and you just lost 3 times your kind of a original risk at basically the same position, because you were betting against a strength on a dollar. Same when it comes to crypto. You will buy 5 different altcoins, and then Bitcoin will just decide to dump 10%. There is quite a bit of likelihood these altcoins will just go down with BTC, even though you might have some solid setups in them. So once again, you need to understand these things, because obviously if you buy 10 altcoins, you will risk 2% on each trade, and Bitcoin will dump. You are down 20% in basically one kind of sitting. So this is not ideal thing. So this is why you need to kind of understand these inner market correlations. Basically, this is why I try to trade less correlated markets, although I trade something like ETH and BTC at the same time, but then I trade Euro, Gold, Crude, and ES, although they are correlated in different forms. For example, you can see that there is 70% correlation with gold and crude. It's still quite high. ES and gold has 74% correlation. They are correlated, but there if you know the correlation is not really 100 or above 90, still it's better than having such a high correlation. So this is something you need to pay attention. As you can see, like Euro stocks and DAX have basically 99 correlation. This is basically they go hand in hand most of the times. So yeah, the correlated markets are something you need to be aware. Stops and take profits. Placing a stop at a level where your trade idea is no longer valid. We talked about this when we covered different setups. There is no reason to move your stop. What people often do is they place a stop in the market and market starts going against them, and they will start to giving the trade more room. They will start moving their stop loss, which will essentially just cause in losing more money. If trade is not working and it's going to against you, take your stops and move on. If you will start moving your stop, you will end up losing more money if it's not going to work out. And if it's going to work out, it will just lead to a bad practice. Then you will repeat it and eventually you will lose money again. I covered where you put stop losses for different trading setups. Obviously, it's a technical type of trading, so your stop has to be at a technical level. Taking profits where a market can turn against you. Once again, I mentioned this. You are placing a take profits at levels relevant to your time frames you are trading, and you are not trying to run every trade to extreme gains, because markets are going to turn against you, and if you are not going to take your profits, you will end up giving it back to the market. So you don't want to do that. You want to be sticking to your, once you place your stop loss and once you place your take profit, you will just leave it there. And if your take profit gets hit and market will continue to the direction, well, that happens, but there is nothing you can do about that. You followed your plan, you made your money, and it's time to look for another setup. Without stop loss and take profit, obviously you are not able to calculate your risk to reward ratio. I know people who are trade without stops and who are trade without take profits. It is possible thing to do, but it's much harder to know your kind of expectancy in the long run. So if you are not 1000% confident with things that you are doing, stick to this classic trading approach. Partial profits are lowering your risk to reward ratio. This is I know a lot of people are taking partial profits because it's comfortable thing to do. Market will go to your favor and you will just close half of the trade and move the stop loss to break even, so you can be like, yeah, I made the money here, it's free trade now. Well, in reality, and there is a blog post about this, if you are going to check out my risk management article, I linked the original piece there. This is right here, so you should go and read that, because what this guy did, he ran different types of simulations, and you can see how much he basically, how much of profits he basically gave away by taking a partial profits. Partial profits can work sometimes, but once again, you are ruining this whole idea of classic risk to reward ratios, and you won't be able to, have any sort of expectancy if you will be just cutting trades all the time. So I don't do partial profits, although it's comfortable thing to do. You take a trade, you make a little bit of money, you cover something, you go to break even. It's you'll feel better about yourself, but in the long run it doesn't really make sense. Break evens and evolving are, if you are a technical trader, putting stop to break even is the least technical thing you can do. Obviously, the break even is often kind of just a random thing. Let's say you this is not a best example here. Let's just very quickly look at just some example. Let's say that you short after close of this candle, expecting something here to hit. Market will move your favor, you will go to break even, you will get taken out and the market will move down. There is no reason to use break even stop losses, although once again it's this nice comfortable thing to do because you are not risking anything, but the break even is just a random level. There is no such thing as a free trade which is caused by a evolving R. You often see people get into the positions which are up, in like 1 hour, 2 hour, and then they will say, I'm going break even, it's a free trade. That's not the case, because obviously, let's take a look at this example. There is a cluster here, we move from here, you will enter the long after the retest of the cluster with target at this swing point. As market is moving to your 2.5 hour target, you will get this rejection from the candle. And let's say, for the sake of the example, there is some insane amount of buying inside this wick. You will have this huge red signal on the order flow that buyers really try to push it and they got heavily absorbed. At the time that your candle is closing, you are up 1.5 hours. So if you risk $1,000, you are up $1,500. Your stop then, can be moved below the swing low. This is what I would actually do, but let's say for the sake of the example, you are still having your original stop loss, or even if you are break even. Okay, let's change that, and let's say you went to break even. So the people will say, after being up, $1,000 to $1,500, people will say that it's a free trade. They are not risking anything. Well, is it true though? Like, if market is going to go against you and will take you out from a trade, you just gave back 1.5K basically. That doesn't sound like a free trade to me. If you are up any type of money and market is giving you signals to probably get out, if it will go against you, and even if it takes you out on a break even, you gave back this 1.5 hour which you could get, and this would be $1,500. So there is no such thing as a free trade, and constantly looking at how much you are risking compared to what you can give back is important. There is an example here on a crude oil. This is we talked about it, and this is actually the trade that I was in. You will get your classic 3 drive into basically a not here, into this QM structure. You had this resistance, we broke through it, you broke the market structure on a sharp move, you are compressing into the levels, so this is a very solid level to sell on the retest. I took this trade and I wanted to run it. I didn't want to only target the level here, which I should have, but there was this kind of a very flat double bottom all the way down here. So basically I wanted this market to kind of flush all the way down here. But as you can see, I entered the trade, we sold off from there. My stop loss, the trade management by itself, the original stop is here. This was around 3 hour, I think. After we broke this low, my stop then went here, and then look what happens here. You start rejecting into, this is also kind of a 3 drive, I showed you this before, but you are putting this failed swing here with POCs, in the wick, higher relative volume pickup. You can see the colored candles. I am up at this point around 2 hour, and market is giving a little bit of a strong sign of possible reversal. If I'm risking $1,000 on this trade, I am sitting in around $2,000 profit, and obviously my target is $3,000, and as my stop loss is just moved into this kind of a high which broke the structure, it's around break even. So at this point I am risking that I will be giving back these $2,000 to the market if we are not going to immediately flush. So my risk is now $2,000 to gain $1,000. Because if we obviously move to my take profit, I am taking $3,000 profit. But if we gonna pull all the way back, I'm giving back $2,000. So your risk to reward is basically 0.5. And is this something you want to be risking? Well, in my opinion, you don't want to do that. So what I did, I closed the trade, and you can see market went higher. Managing drawdowns. So drawdowns will happen. You might want to think that things that you learned here or that your overall strategy is bulletproof, it's the best strategy ever, but you still manage drawdowns. There is no way around it. And there are two types of drawdowns. You can be in drawdown in trade. With a lower trading frequency in swing trading, it is good to give trade some space. So if I, for example, take a trade on H4 time frame, I'm not going to overmanage it. I have my stop in place and just let the market do its thing, because I know it can take time for a move to happen. With higher trading frequency though, on day trading, there is no reason to hold trades in a large drawdown, as next opportunity can present itself soon. So if I'm day trading, I'm much more strict. I enter the market, I want to see the immediate reaction. If it's not happening, I'm out. If I'm swing trading, I'm giving the trades a little bit more room. You want to see if you are in drawdown, you want to be looking at new structure to form against you, where you could basically go to the opposite direction. So if you are in a trade, and I will show you some examples in a bit, if you are in a long position and market will start kind of forming something which would essentially give you the valid short entry, you don't want to be in that trade anymore. Account drawdown, during overall account drawdown, is good to look at failed trades and review overall trading approach. Drawdowns are normal and happen to everyone. If drawdown gets too prolonged, it is advised to take a break and review your trading approach. During the period of drawdown, there is no reason to adjust your risk profile. So you want to be journaling your trades. You want to be taking screenshots of every trade. A couple of years ago, I did have a really bad losing streak. I was like down on a month, and I was, it started to getting to me. I felt like, every trade that I take, it just sucks and it's not going to work out. But I kept a journal of all previous trades, where for every winning trade and also obviously for every winning and losing trade, I put inside a screenshot with all the setups that I took. And as I then when I was in a drawdown, I just went through the journal and looked at these past trades, and it really helped me to kind of keep focusing on these things as I gain more confidence that are working. So this is one of the great things of having actual journal and sticking to your system. This is important. During the period of drawdown, there is no reason to adjust your risk profile. What I mean by that is, obviously, let's imagine that you will be risking 2% on each trade. So you will risk 2%, you will risk 2%, you will risk 2%, and you will risk 2% on each of these trades. And all these trades will end up in losses. They won't work out, and you are down 6% of the account. You are obviously bummed about that, so you decide that you will start only risking 1% on a trade. And obviously what will happen in every situation is that this trade will actually work out. So you are now down 5%, you take 2 more trades with 1% risk, they will also obviously work out. So now you are still in a 3% drawdown. If you would stick to your original 2% risk, you would be basically at break even. So this is why, if the drawdown is not extreme and it's not prolonged, when you actually have to take some like overall break, there is no reason to adjust your risk profile after just a few trades. Just stick to what you said you will be doing. This is one of those examples for day trading when you will just bail out from a trade. There is a failed swing on this intraday time frame. You have these buyers trapped for whatever reason, you will just go short. Market will then sell off, but look what is about to happen. The huge pickup in selling, and also the longs will puke. This is a net long and net short indicators. I didn't include it here because I don't use it all the time, but it's tracking open interest in exo charts. It's only available in exo charts, and it's straightforward, it's just tracking open interest of long and short positions, but I'm not using it that much to include it here. I just sometimes look at what is basically the important thing here is this kind of a down delta in the next candle. So you are in a little bit of profit, but then market is starting to go against you. If you decide to stick to the trade, then you have this. Basically, this is your new kind of a cluster, and this is new kind of a structure. You are getting out from a trade here. There is I would personally just bail from a trade the minute it starts to pull back, because after selling like this, if market immediately is not going to continue, it's going higher. But if you decide to stick to this trade, and market will form this kind of a new structure, this can be also seen as a QM, basically, where you have let's just wait a second, you have a support, you have this high, you break below it, and you make a higher high here. This is a valid reason to go short. You need to cut the trade here. There's no reason to hang around for a longer period of time. This is your swing kind of setup, so there is much less order flow, but the same thing, cluster, large sellers stepped in, it went below the structure. It's a good trading opportunity. You will go short here, but nothing is about to happen. Market will pull back, almost take you out. I would say that I would, after this thing and move lower, most likely move my stop here, but in case you didn't, market will pull inside, almost take you out, goes down, but look at what's about to happen next. You will get these failed swings and these volume pickups inside the wicks. There is no reason to stay in this trade. You would, if you would cut the trade in here or here, you would save yourself money. You can see that if you would look at lower time frames, this would be a V reversal back to the structure, and you would have another QM kind of here. If you take a look at this level of support, basically, that gets broken, you make a new high after a V-shape reversal. This is a solid idea to get long. So if you are not, you don't have to flip your positions. This doesn't mean you must get long, but if you are in a short from here, there is no reason to stick around to experience a full loss. Okay, so the building accounts. In trading, you need money to make money. You will be risking 1% or 2% per each trade. So if you can consistently achieve 10% of your of gains in every month, your account will compound very quickly. This is once again something which got completely ruined in crypto, for example, where people post these massive wins, how they make thousands of percent in a couple of weeks, but realistically you will grow your account much slower than that, because these people obviously they gamble, they can afford to lose the money. So if they risk 20% on each trade, for example, which is something you don't really want to do if you want to take this thing as your kind of a career choice. So growing your account anything between 10 to 20% each month, and doubling your account each year is amazing, and it will compound extremely quickly. You will see that in a real time basically. But you know, if you, let's say you will double the account in a year, and you want to be growing that, well, how much money you need for that? You know, if you need, for example, $5,000 every month to make a living, it would mean that you are trading with $50,000, and you will be, you know, pulling away that money every month, so your account will actually not grow. So you can easily see that you need a lot of money to make money in trading, to make a living in trading. You know, if you are new, you can start with $5,000 or $10,000, but it's nothing near to realistically, you know, being able to make a living from, and, you know, kind of provide for yourself or your family, obviously. And this is where most of you will be, and most people who message me are actually. But so let's think about this. Let's think about, you have only $5,000 to begin with. You know, if you have less, you know, nothing you can do about that. But let's say you have 5K. If you will be risking 1% on each trade, it means that you are basically risking $50 on each trade. I am pretty sure that most people will just become bored about this very quickly, and they will start, you know, increasing their, you know, risk, because, you know, $50 is not that much money. Obviously, you know, it will basically just lead to risking too much money if you will start to being really strict with small risking on a lower accounts. But let's say that you will start, or what I kind of suggest people to do is start with this 5K and risk this 1% on each trade, and stick to it for 3 months. Okay, if you will stick to it for 3 months, and you are not running some strategy that will only trade one trade a week, but you will be doing this either day trading or kind of this medium intra-week trading, and you will be able to gather around 50 to 100 trades during this period. You will get a decent kind of a sample size of your expectancy. You will be able to see that, you know, you are basically trading a strategy with, I don't know, 60% win rate, and, you know, 2.5 hour risk to reward ratio. If you know this number, you will know basically that you where are we? There is a losing 7 or 8 trades in a row has only 2% chance. You know, and you will more likely than not won't risk more than 5 trades in a row basically. If you know that, you can then increase your risk parameters. You know, you will know that you are not going to be, you know, most likely won't lose more than 5 trades in a row, and you can say that for this smaller account like this, even if you lose 20% of your money, you will, you know, the 20% loss then would be $1,000. So if you will be able to stomach that, you can start risking 5% on each trade, which would be, you know, obviously equal to $200. And but if you will make a 10 hour each month, which, you know, obviously is kind of this if you will, you know, obviously if you lose a trade, you will lose 1 hour. If you take a trade with 3 hour and it's a winner, you made a 3 hour. So if you will average, for example, 10 hour on each month, this will obviously equal to $2,000. So you will be only on making a 10R on a month, which is I think a achievable thing to do. You will be making almost 50% of your overall account balance. So thanks to that, your account will start growing quickly. And once obviously your account grows, once you are at 10k or 20k your overall balance, you can then revisit this 5% risk per trade, and you can start lowering it to, let's say, 3%, and then essentially 1 or 2%, where you will have this more of a conservative risk profile. But all of this is only possible if you will start here. If you will gather your data, if you will have, I would say at least 100 trades is actually better than only 50. So having at least 100 live trades. The trading on a demo account is fine, but when money is involved, even if lower amounts of money, it's actually it will change things. You might think it's not true, but it's once money are on the line, you will start thinking differently. So once you have this journal with live trading examples and enough data that can tell you what sort of drawdowns you can expect and everything about your strategy, then you can start risking more money. You can change this conservative 1% approach to 5%, and then your account will compound way quicker, basically. So this is how I would, if I would be growing a small account, I would do it. And you will see that within a couple of months, if you will be successful, you will start to kind of be around that 50k area, where making 10% a month equals to 5k, which is something that you can start working with much better. Trading psychology, this is obviously a huge topic in trading. There are millions of books about trading psychology. It's extremely popular topic, and we are all different people, but most people just blame trading psychology because they don't really know what they are doing. Your main job as trader is be able to show up next day, and you need to be focusing on a long-term growth instead of putting too much money into your trading account, trying to kind of fix everything with money and risking too much and want to achieve things too quickly. There is nothing that improves your trading more than a screen time. You just really need to trade. It's you need to trade, you need to journal your trades, you need to be gathering those data I talked about. This is much more important in my personal opinion. Once again, I cannot talk to everyone because I don't we don't know each other. So you might have some psychological problems that obviously I cannot help you with that, but I believe that focusing on this long-term growth, on this long-term process, being really consistent with things you are doing will help you 10 times more than any trading psychology book, basically. So okay, I know this was a longer one, but these things really need to be said about risk management. So without further ado, let's actually take a look at these different strategies.